Hi everyone, I'm Teng Chong, Research Analyst here at iFAST. In this video, I'll be sharing the basics of investing in bonds. In the last video, I shared about the terminologies when it comes to bond investing. For this video, I'll be introducing the pros and cons of bonds and also things that you should consider before purchasing one. After the previous episode, you may be thinking, what are the pros and cons of bonds? So firstly, the pros of investing in bonds is bonds provide fixed returns to investors. For bonds, the returns on investment is clear, where investors are paid according to the coupon rate of the bond. As compared to stocks, it is hard to accurately predict the returns you may get from stocks. Adding on to the first point, bonds provide a form of capital preservation. Bonds at their maturity pay back the amount invested plus the amount earned from the coupon payments, whereas for stocks, the returns and your invested capital may fluctuate and is unpredictable. Lastly, bonds are less volatile as compared to stocks. Bond prices may fluctuate according to interest rate and inflation rate changes, but are generally more stable as compared to stocks. With all that said, there are definitely some cons when it comes to investing in bonds. The biggest con would be bonds yield lower returns than stocks. For a more stable and less risky investment, bonds provide lower yields and returns as compared to stocks. A corporate investment grade bond typically will pay around 2 to 3% as compared to the S&P, where it generated an average return of 10% in the past 30 years. Next, a larger capital outlay is required to invest in bonds as compared to stocks, and the minimum sum required to purchase a corporate bond is $250,000. There are also other options such as Bond Express, where you can purchase corporate bonds for as low as 5,000 Sing dollars, but you need to be an AI. There are other alternative options such as SGS bonds and Singapore savings bonds, but they pay a lower coupon rate. Lastly, companies, especially companies with low credit rating or are highly in debt, may default on their bonds and cannot pay back their debt obligations. Bonds may lose some or even all of their original capital during a liquidation event. However, bondholders do have certain priority in payment during a liquidation event over common stockholders. So, now you know the basics of bonds. Now let me share with you the things that you have to consider before selecting a bond. Firstly, investors should consider their risk tolerance before investing in bonds. Although bonds are relatively safer as compared to stocks, they still bear some risk in default and non-payment. Therefore, investors should understand that their risk appetite before investing. They should ask themselves these questions before investing in bonds. If an investor is risk averse, they may consider safer and lower yielding bonds such as sovereign bonds, while a more risk-seeking investor may consider high-yield corporate bonds that give higher yields for more risks. Expected returns are a critical consideration when choosing a suitable bond to invest in. Unlike equity markets, investors who may have more difficulties in establishing reasonable forecasts for stock market returns, a fixed nature of fixed income allows one to have a better sense of potential investment returns. In fact, if an investor holds a bond to maturity, returns are known in advance, in the absence of default by the issuer. Deciding on the level of return required on a bond allows the investor to focus on a particular segment of the bond market where such levels of return could be achieved. The best proxy for establishing a potential return for a bond investment is its yield to maturity, which is an annualized measure of the rate of return expected from a bond over its lifetime. The higher the yield to maturity, the higher the potential investment return compared to a bond with a lower yield to maturity figure. Typically, higher yielding bonds tend to be issued by lower quality companies or governments whose credit histories are more suspect. Intuitively, companies or governments which have a better credit standing have bonds which command a lower yield. Next, investors should be aware the riskiness of the bonds they are investing in. As is common for most investments, the higher the potential the return, the higher the investment risk. For bonds, risks center on number 1, creditworthiness, and number 2, interest rate movements. Creditworthiness is dictated by the likelihood of default by an issuer. Since bonds are essentially loans to companies or governments, A more credit-worthy issuer would entail lower risk of default, while the converse is true for less credit-worthy issuers. Understandably, bonds which offer better potential returns tend to be of those lower quality or highly leveraged companies and governments. One way to determine this would be through the bond's credit rating. So as mentioned in the previous video, investment-grade bonds are ranked AAA to BBB- on the S&P and Fitch rating scale, or AAA to Baa3 on the Moody's scale. Non-investment grades are BBB+ or lower on the S&P and Fitch scale, or Ba1 or lower on the Moody's scale. So investment grades are less likely to default on their bonds, while non-investment grade bonds are riskier and have a higher probability of defaulting. So for more risk-averse investors, they may consider bonds with a higher credit rating, such as between AAA to BBB-. As most bonds have a fixed maturity date, it is important to understand and know your investment horizon. If investment capital is required for short-term needs, investors can consider a shorter dated bond. Let's say you have a short-term commitment such as a house renovation within the next 2 to 3 years, and you would like to put your money in a bond so that you can earn interest payments before using the money for renovation. You can consider a shorter term bond with higher credit rating, so to ensure that you still earn some interest payments while not risking too much of your capital. Bonds of longer tenure is more susceptible to interest rate risk due to its longer duration. So when interest rate rises, bond prices fall and vice versa. With longer maturity bonds, they are more sensitive to rate changes. This is because longer term bonds have a greater duration than short term bonds, they are closer to maturity, and have fewer coupon payments remaining. Long-term bonds are also exposed to a greater probability that interest rates will change over its remaining duration. Now, after hearing about the pros and cons about bonds, some of you may be excited to buy bonds. So, where can you purchase bonds? Most corporate bonds are transacted over the counter and can be done through iFAST. For AIs who want to transact less than 250,000, iFAST offers Bond Express. Bond Express is an initiative that allows you to trade a selected list of wholesale bonds with firm executable pricing and volumes, but more importantly, in lot sizes from as little as $5,000 for USD denominated wholesale bonds or SGD 5,000. Wholesale bonds are typically traded in lot sizes of 250,000 SGD or $200,000, which may be an onerous capital outlay for many investors, resulting in a lack of ability to diversify. With this initiative, you'll be able to enjoy the benefits of yield certainty that comes with investing in corporate bonds, yet still enjoying the diversification benefit that has been a long-standing pillar of our investment and portfolio advisory process. I've come to the end of my sharing on what you need to know before you start investing in bonds. Thank you for watching.